The volatility that we've seen across the small cap space, really which started in September of 2021, has continued. It has been an incredibly volatile market. And when we see periods of volatility, you generally see investors be more favourable towards larger cap companies, such as banks and resources, because they're much more liquid or a bit more of a safe haven, let's call it, compared to smaller cap companies. And that trend has broadly continued over the start of this financial year. Pleasingly, from our perspective, we've been able to outperform the market in the first 4 months of the year, which has been great. It's been really pleasing despite those headwinds. And if we look at our portfolio at the moment, we're very positive on our portfolio. And this reflects the fact that valuations are very, very cheap at the moment. Small cap companies relative to large cap companies are trading at 25-year lows in terms of valuation. Balance sheets are very, very strong. Vast majority of our portfolio has more cash or property than debt owing on their balance sheet. We believe our companies are in a very good position to face what was probably going to be a tough year in calendar year 23. Pleasing thing for us is the markets always look 12 months in advance. And if we look at the macroeconomic environment at the moment, it does feel that interest rates rises are starting to peak. Inflation, we're seeing a lot of the inflationary indicators come off, such as freight, logistics, used car sales, and so forth. So we do think the market will start pricing in a more stable environment for interest rates in the future in calendar year 23. And that'll be very good for small cap companies that have been heavily sold off. There's plenty of stocks out there at the moment, particularly ones, and these are the ones we're interested in, where they're trading at a share price below, say, their property value, where you're getting an operating business for free. A good example of a company we own in the agricultural sector is Select Harvest. Ticker is SHV. It's the largest almond producer in Australia. I reckon almonds, Tobias, what do you reckon? Worst commodity over the COVID period. It's probably the only soft commodity that hasn't gone up over this period. And it's largely because the United States or California had a record crop 2 years ago. Now you're just working through that carryover of almonds at the moment. And what you're seeing at the moment in California is a chronic drought. Now, it will take time for that to come through. But when we're looking at the stock, you're looking through this weakness and you look at what the actual assets of the company are worth. The share price is currently trading at about $5.50 a share. And we think the market value of the assets are $6.50 to $7 a share. So we're buying this company at a 20% discount to the asset value, and we're getting the operating business for free. So for us, we're happy to wait there, wait for the almond price to recover, and we'll see the rewards come through in the share price.
Another good example is a company called Estia Health. It's an aged care operator run by a very competent board and management team. Now, the aged care sector as a whole has had a very tough time over the last few years, firstly with the Royal Commission into aged care and more recently with COVID. However, we believe that's now behind us. We believe if you're an efficient operator in the aged care space, there are a lot of opportunities from an M&A perspective to acquire good assets at very attractive prices. And at the same time, we've seen quite a few large takeovers of aged care operating groups. And we believe Estia itself is the target of potential acquisitions. So we think the intrinsic value is over $3, and currently the risk reward looks to be very attractive. We continue to be very selective in tech. However, more recently, we have invested in a few new positions. Now, we are drawn to the defensive business models and the growth profiles of some of these companies, and the valuation has come back quite a bit. For us to be interested in a technology company, it needs to tick 3 boxes. The first box is it needs to deliver at a minimum 10 to 15% of organic growth rate. Secondly, it needs to have a net cash balance sheet. And finally, it needs to have strong operating leverage and to be trading on a very reasonable earnings multiple. Now, our preference is also for founder-led businesses, given the stronger focus on cost. Now, we believe these companies are the ones the market will gravitate towards when they look for growth. In fact, we're already seeing some signs of this. Private equity players and strategic buyers are seeing value in the small cap tech space. Been quite a few acquisitions and takeovers recently. I think if you look over the last 18 months, over 30% of the tech companies in the All Ordinaries Index have received at least one takeover bid. So we continue to see this trend playing out, and that's why we're getting more positive on the sector.
And Tobias, you're being very modest here, but we've actually participated in a few of those takeovers in WAM Microcap and WAM Capital. So that's Elmo, ReadyTech, and of course Tyro Payments. So well done. Mining services sector, we've been in for a long, long time. It was a frustrating sector for us coming out of COVID because a lot of these companies were getting hit by, labour pressures from minimal interstate migration and also immigration from overseas. Since the borders have reopened, these companies are now receiving a tailwind around their cost base, and also with very strong commodity prices, we're seeing a very strong outlook for construction and also producing assets for mining companies across the country. So in terms of our favoured exposures across WAM Capital, we have NRW, ALS Limited, Seven Group, and then in WAM Microcap, we also have Mermaid Marine, SRG, and Austin Engineering. We're quite bullish on the retail sector. Unemployment's very low. There's still a lot of pent-up savings that's out there. Look, no doubt that's going to be a very tough calendar year 23. However, a lot of these companies have been priced in terms of their share prices. So we're actually quite bullish into Christmas for a number of companies such as Myer, Premier Investments, and also Lovisa. These companies have also very strong balance sheets. So we think they can weather the storm, and I think the valuations are cheap enough where they can get through this tough calendar year 23, and it'll look good into subsequent years.